My name is Michael Guyad, publisher of the Lead Lag Report. Joining me today is Weston Nakamura. Weston, a lot of people consider you one of the real experts when it comes to currencies, Japan. So a lot we're going to get into here. But first time you and I speak, introduce yourself to the audience and to me. Who are you? What's your background? How'd you get involved in interested in markets? And where are you looking?
Sure. So as I always do say, that as flattering as that is, there really is no such thing as a bank expert, including those at Bank Japan. Because I'm not going to Bank Japan people either. It's just that this is all uncharted territory. And so there is no such thing. There's no precedent. As for me, so I am originally from New York. I've been in Tokyo for the last decade or so. I basically used to, I have a horrendous academic record and all that. I'm not like a quote finance guy or whatever. I moved to Tokyo at the start of Abenomics because I wanted to get into institutional finance to a too big to fail institution, because after 2008, I figured that's the only job security that there is out there. I basically moved here with literally nothing, just like a suitcase, kind of hopped around to capsule hotels, but I was kind of banging down the doors of every financial institution in Tokyo. Of all of them, Goldman happened to notice the insane thing that I've done. And then 20 some odd interviews later, I was at the listed derivatives, futures, options trading desk. And so that's how I got into finance. And then from there, basically the great thing about the futures desk is that we were doing mostly equity derivatives, but you talk to the GTB traders, the rates traders, crude oil, gold, whatever it is, obviously equities, FX. So you see like a cross-asset picture. And so I had an institutional career. And then after a while, I moved over to hedge fund sales. And then basically I joined Real Vision for about 2 years or so. That's where I kind of switched from, being an institutional monkey to a talking head, I suppose. And I would just kind of give my various views on this and that. And then I suppose that I guess I became more noticed in early 2022 in January, when I first gave a heads up to people that hey, everyone needs to watch the Bank of Japan. I know it's a very sleepy policy, unchanged for 50 meetings straight, central bank, but this is a year in which you're going to see central bank policy divergences. You're going to see nominal yield spread differences. You're going to see yields blast higher because of inflation and so on and so forth. And you're going to see it's going to expose or lift the cover off of what the Bank of Japan has been doing, which is basically yield curve control. And what that is basically just the Bank of Japan artificially suppressing 10-year JGB, Japanese government bond yields, down to pinned down a specific level of around zero. At that point, it was 25 basis points. And when they do that, it's going to expose that they're doing that when everyone lifts the QE veil and Japan's the only one kind of left. So that's kind of where I gained, not prominence, whatever you want to call whatever my card setters. And I'm currently at Blockworks Macro, and I have a podcast called Market Depth. And basically what I do there is it's like a wonderful kind of almost dream come true situation for me personally, but I basically get to discuss what happened out of the Asia Pacific region in markets or developments that have impact on global cross-asset markets, like US equities, whatever it may be, rates, FX, commodities, whatever it is, primarily focused on China and Japan, because, when I went back to New York for the first time post-COVID, last year, I was trying to get overnight, what happened overnight in Asia markets, just kind of like financial media or whatever it is. And there's zero coverage. And it's kind of insane how that's possible, because Asia starts the trading day every single day. If something happens over the weekend or whatever, Asia is the first market to get a market read or reaction. According to the IMF, the 70% of global growth is going to come out of Asia to this year, most of which is going to be China and India. Japan, being the largest foreign fixed income investor, has the largest foreign credit to the United States, has massive implications on U.S. treasuries, i.e. massive implications on the risk-free rate, which therefore affects every asset class. And so I try to convey that to the audience. And the way that I do it is going back to my background. When I was on the trading desk I would have like hedge fund clients, whoever they may be, and I would just give them kind of market color or whatever it is, something that I'm seeing, but I'm trying to give something that like to them like differentiated. Like they don't need to, nobody needs to know where, SPX E-mini is closed or what the dollar yen did today. They can just look that up, right? I'm trying to bring something that is being overlooked or something that is differentiated of value. And so that when you see something in, your inbox with my name on it, you don't just kind of glaze over it. Every single thing that I say, 100% of the things that I say are of value, at least in my opinion. That's why I'm bringing it to your attention. Otherwise, I wouldn't be bringing it to your attention. So that's what I get to do on market depth and what I aim to do. And so, yeah, that's basically it.
So a lot of different questions come to mind, but first, I'm just curious. Talk about some of the cultural differences of working in finance in Tokyo versus what we experience in the U.S.
I've never worked actually on an institutional desk in the U.S. I've been on, I've obviously visited like and all that, but I suppose that the stark differences are clearly just the culture of business in general, I guess, between Japanese and in the U.S. For example, at Goldman, in the equity team, like there'd be basically the equity sales traders, for example, there's an international client coverage like team. And then within that same team, the same exact job or same exact role, but there's like the domestic coverage. But they're two like completely different worlds. Like one of them is just white shirt, black suit pants, and are just very kind of quiet and sitting there. The other ones, like we're throwing M&Ms at each other, and wearing jeans and stuff like that. And so it's like a very different culture. JGB traders are extremely domestic and things like that. And so I guess that there's like those sort of differences, but the biggest difference I would say in terms of how it relates, how it would relate to just the everyday investor out there is that despite Japan being, a huge whale in sovereign bond markets and equity markets and all of that with trillions deployed overseas, they're not necessarily like buying treasuries, for example, or not buying treasuries based on something like US CPI or the Fed even. They're just doing so because they have a portfolio allocation. So it's just some mid-level guy that's just blindly buying, billions of dollars of treasuries, or whatever it may be on it, just to fill a spreadsheet or something like that. And it's very kind of mechanical almost. And there's so much that happens within Japan, I guess, that isn't being covered with, or isn't being looked at, or is being overlooked by the broader global investor ex-Japan. And then within Japan, I call Japan the developed world's North Korea. Like there's so many, it's in such a bubble within itself that it's kind of insane. Like the example I always give is like November 2016. This is election day when, the Trump versus Hillary election. And then so when that happened, results came out, big upset. Donald Trump beats Hillary Clinton for the US presidency. Markets go super risk off, like 5% down on every, futures index immediately and all that. And right into the close. And then I had a client, a large institutional client that you would all know. And he called me and he asked me why Sony is down on the day. I was like, dude, every stock is down like 10% on the day. Like, you're not aware? Like this is US election. Like there's a very unknown candidate just won the presidency. That's why. But he's looking at bottom-up fundamentals of Sony. And he's looking for news on Sony. And like these are institutional level people, right? I don't know if that happens anywhere else. I seriously doubt it. But what I don't really like accuse per se, but what I try to do is like try to tell my fellow Americans like, hey, look, you really need to not be so US centric. You have to be very global minded, which I know you are. Well, like you're always flagging things like the end. You have to be watching Japan, so on and so forth. But a lot of US-based US investors are very US-centric in what they're looking at. And despite US being the center of the universe, which I agree with, because of that, everybody invests in the US, and therefore US investors need to be aware of what's happening outside of the US with those investors, because if something happens, somewhere else and they have to liquidate gigantic US holdings or something, that's going to affect your portfolio. So in that sense, I always try to tell US like investors, this is the entire purpose of my podcast is that not just the US, but like just to inform people of that. But then on the other side, Japan is much, much worse in terms of, I don't want to paint too broad of a brush, not everybody, but Japan is extremely inward looking only and has really no idea about, or doesn't care to even know about things that are happening in the outside world. And so you might see very weird things like them, people just, buy or sell treasuries when they quote unquote shouldn't be because something major is happening in the US or what have you.
Right. I think the point is that it's commonality, right? There's home biases everywhere. It might be stronger in some cultures and countries than others. So you had mentioned at the very start, uncharted territory. There's no precedent. Outline for the audience a little bit of the history.
Can I just make one comment on that?
Yeah.
The one thing I will say though about the US based investors is that, and this is something I only noticed once I got out of the US, but for everybody else, the thing about the US US investors is kind of handicapping them is that the US dollar, like FX in general, is not something that US based people really think about but everybody else in the world has some sort of currency, minded approach, just like regardless of whether you're in finance. You look at like your GBP USD, EU or USD, whatever it is. But in the US, it's just USD, right? So there's no need to look at or think about currencies as like a global pair trade or whatever. And so therefore, like the FX asset class specifically goes largely unnoticed with US investors. I think that's something that the world reserve currency holder is kind of being blind to as a function of it being the world's reserve currency.
Yeah, and the yen is unique from a lot of perspectives, and Japan's obviously unique from a lot of perspectives we'll get into. But where we're going with that question about no precedent and uncharted territory. So take the audience through a little bit of a history lesson in terms of what happened at peak in '89, the structure of Japan's economy, and the birth of the carry trade. Because to me, it's ultimately that's the thing that people are not understanding about the interaction of Japan to all global markets.
Sure. 89, I was, I don't know, like a toddler at that point. But so Japan, believe it or not, once upon a time, Japan had animal spirits in markets. So there's a massive, massive asset bubble in Japan in the late 80s. And basically it crashed I think the top tick was literally, New Year's Eve, 89.
Yeah, like December 31st, I think.
Yeah, right beneath Nikkei, right beneath 40K. And the Nikkei just crashed since then. Japan's been in, decades of inflation and just look at a chart of like Topix Banks Index, for example. It looks like the Citigroup stock chart post 2008, just like, flatline on the ground. And, but what that did was essentially what the Bank of Japan has been doing is due to both the need to get animal spirits and kind of snap Japan out of a deflationary mindset and deflationary behavior, and combined with the fact that Japan has a massive amount of sovereign debt, most of the world currently 260% debt to GDP, and only getting worse. Japan's central bank, the Bank of Japan, has been having a zero interest rate, currently negative interest rate environment since like 2000 or so. And what that does is when you have a currency like the yen that is large and liquid, third most traded currency in the world, that has a negative or zero or negative, basically like free to borrow, then it encourages what's known as what you just mentioned is the carry trade. Carry trade is basically, just put simply, is when you're borrowing in the currency at nothing, at zero, and you're investing in a currency that has a positive yield, and then that yield spread differential, that's your carry, that's your positive carry. And so a lot of times, especially take up to like leading into 2008, for example, during the housing bubble in the US and a lot of like subprime derivatives and, CDOs and things like that, a lot of that was actually funded by this carry trade in which people would short the yen, go long the Aussie dollar, for example, and they would take proceeds from that and then they would invest into risk assets or whatever it is. And what happens though is that when you get a bubble or whatever it is that they're invested in, when that unwinds, so goes the carry trade. And when that happens, like in 2008, I think it was in between Bear Stearns and Lehman. So it's like something like June or July 2008. Just look at a chart of AUD JPY or AUD USD. The Aussie dollar basically gets cut in half within like 3 months. And that's a vicious unwind of a carry trade. And then that leads into, other risk assets as well. So carry trade is basically kind of the fuel that keeps assets alive, I suppose, or buoyant. And they are subject to getting unwound should the carry trade that is funding it get unwound or reverse, i.e. yen strength.
Right. And I think this is where the mechanism comes into play as far as the risk for markets now, right? The thesis that I have here is that, especially with oil rising at the pace it's rising, if the yen were to keep falling, oil denominated in yen is going to keep surging. That's going to be even more inflationary. You talk about 4 decades where Japan hasn't really seen or even had to think about that. And that probably means there has to be some kind of intervention. And if the intervention means the yen then rises against a lot of speculative short positioning in the yen, that creates a ripple effect. Correct me if I'm wrong on that thesis, but it seems like that's not that far-fetched in terms of creating a global tail event.
No, not at all. I mean, what are you saying to give the potential other side of this?
Yeah, just that sort of reaction to that, and timing is obviously everything with this. But so I just shared the nest. If you look, for example, at the dollar yen versus speculative short positions on the yen, and then correlation against tech. I mean, it seems like a lot of the AI mania, you can even argue to some extent, might be funded from the carry trade this year. So the point is that it could unwind in conceivably a pretty shocking way, such that it results in what I would argue is a global margin call.
Yeah. Global margin call is a very good way to put this. Okay, so I very much like this correlation to tech. Can I add a chart to this? Because I have something very relevant to this that's basically...
Yeah, if you tweet it out, I'll share it. If you tweet it out, I'll share it.
Yeah, okay. But yeah, so basically that net yen short futures that you see there, Michael, I'm guessing that's like the lever opportunity for CFTC, COD?
Yeah, the CFTC, exactly right.
Yeah, okay, so what that is basically... So the reason that the yen has been such a short yen has been such a crowded trade is because from 2002 is because if you actually look at, all right, in 2002, hedge funds, traders, they just dove headfirst into shorting yen futures. The reason is because that was not necessarily a Bank of Japan play, but that was more so a Fed play, because for the first time in a very long time, rates traders who would usually bet on, who usually use instruments like Eurodollar futures or like short-term interest rate futures to kind of speculate on where Fed funds will be at what level, when. That was basically almost getting impossible to do when you have like Saturday or Sunday, Nick Timrose sort of leaks about 50 basis points, now going to be 75. And there's so much uncertainty with like the next Fed meeting, right? And you had implied volatility on those instruments, on Eurodollars and whatnot, for short-term interest rates, like surging. And so if you look at a chart of implied volatility on those instruments, and then you look at the actual yen futures price action, they basically diverge. They're mirror opposites of one another. And what the yen carry trade represents is that short-term interest rate futures traders would basically say like, all right, I don't know what the hell the Fed's going to do. However, I'm just going to play the policy divergence trade. Fed's going to be hawkish. I don't know exactly how and what mechanism, but they're going to be hawkish. They're going to be raising rates. The Bank of Japan is apparently just standstill. And so therefore, if I do a relative trade in which I, and short the yen or short the yen or short, or long JGBs, for example, and short US treasuries. In other words, like betting on a yield spread, a US to Japan yield spread to widen. That is a short yen trade. That's a long USD trade and therefore a short yen trade. So a lot of that basically came in, and you got a ton of hedge funds just put on yen shorts. And again, it's a Fed trade. Fed is going to be relatively more hawkish than the Bank of Japan. Problem is that when either of those, but if either the Fed becomes less hawkish or Bank of Japan becomes hawkish or relatively less hawkish, that can unwind. And so that's what you're seeing with like that speculative net short yen position. And then as far as this year though, in 2023, the upside that you're seeing I just sent Michael, I just sent you this idea, this chart, but this is basically, if you're wondering why the NASDAQ has been killing it this year, I go over this in my podcast as well, but basically, if you look at this chart of the NDX 100 futures, so NASDAQ futures, and then the Nikkei 225 futures. So first of all, the Japan equity market has been outperforming every other GA equity market by miles, in the second quarter of the year. That was kicked off by Mr. Warren Buffett, giving a stamp of approval for Japan. And then you got something like 13 consecutive weeks of inflows from foreign investors. It's purely foreign inflow led upside for Japanese stocks. And Japan equity market still continues to outperform. But when that happened, right, you basically, before that, you had the Nikkei index that was below 30,000. 30,000 was a very, very cement ceiling above the index that it could not break through. Like in 2018, 2019, when every single equity market regionally, everywhere in Europe and US was making new highs, all that. Japan was just getting stuck. It was just, the Nikkei was just getting trapped under that 30K level. So when it broke through 30K in, May or whatever this year, that's when it really started to take off. And that's when you start to see real huge inflows coming into the Japan equity market. And then that's when you start seeing the NASDAQ 100 index start to correlate almost tick for tick with Japan. In other words, the Nikkei index for that, it's not so much anymore as of recently, but for that huge upside move for the last few months, the Nikkei index had been driving especially the NASDAQ index upwards directionally. And it's not because necessarily of Japan investors or Japan for that matter. It's because of the fact that this was, again, foreign capital inflow led rallies in the Nikkei index. And so therefore, it would be US investors or European international equity investment managers. The active capital was in Japan. That's why it would lead the rest of the other indices, including the US. And so there was a very, very tight correlation. And then you could also see AUD-JPY. That's another carry trade that was also sort of fueling and funding that as well. So that's why you see kind of a correlation with that. And then as the Nikkei index would rise, you would also see a very tight recorrelation of USD-JPY. So that's yen short, Nikkei up, NASDAQ up. That's what ties all of that together. That's why you see that correlation just, like that. I don't know if that's was it 30-day, 60-day correlation? I don't know. But yeah, that's pretty telling.
I believe it's 30. Yeah. That was actually something by somebody else, but it made sense anyway. But I think that that's the point. It's everyone, I've heard a lot of people saying, listen, there's still so much cash on the sidelines. What's driving the equity move? And the simplest answer is usually the right one, which is the one you just gave.
Right. And so there's two, in terms of equity markets, let's rewind back to, let's say up to a month ago. Okay. So from May to, let's say, June or April to the end of June or end of July or whatever it was, there was two main themes within the broader developed market equity space. And that would be AI, long AI, long Japan. The thing with the long Japan thing was, and then AI, obviously you saw obviously everyone knows, saw a ton of inflows and all that. You look at the Nikkei index, it actually matches up quite well with that of the stock of NVIDIA in terms of price action and direction. But the Nikkei index is very kind of a very strange, weird index because first of all, it's price weighted, which is the stupidest way to make up, an index composition or to weight an index. But nonetheless, the Nikkei index is a very weird composition because the biggest weighting is fast retailing. It's the only double digit weighting. Fast retailing, for those of you who don't know, is Uniqlo. Okay. Basically, it's like having LLB being the top weighting of your index. Then after that, though, you have a couple of AI and tech plays in there and semiconductor plays in there as the heavyweights. So if the Nikkei is a kind of a hybrid between a value index, just because Japan equities have been value or value staff or whatever you want to call it, it has the value label on it. And at the same time, it also has AI and sort of kind of these tech momentum components in it as well. And so that that's what I guess really just attracted so many different cohorts of both value investors like Warren Buffett to people chasing, 6,000 PE or whatever names all in one, all wrapped up in one. So yeah, so that's what the kind of strange, weird thing about the Nikkei 500 is. Another thing too is that because of China too. So like the Hang Seng Index in Hong Kong has just been, horrendous, right? And if you look at that, the long China reopened trade that kind of fizzled out immediately at the beginning of the year or shortly after the beginning of the year, a lot of funds that were allocated to that long China reopened trade that got reallocated over to Japan. So you also have like a kind of almost like a long short or overweight, underweight of Japan inflows at the expense of China outflows from foreign funds as well. So there's also that component. So there's like a lot of these, there's both AI and tech and all that. There's value investing. There is the fact that there's still easy monetary policy in Japan. There is the rebalancing or the portfolios that really just drove up and not just drove up, but had a lot of the global equity activity centered in Japan. And therefore the Japanese indices would kind of dictate more or less or lead the rest of the indices, including like the NASDAQ. And then at some point, if you're sitting in if you're an equity manager or if you're a cross asset manager in the US and you're collecting, 4% yields risk free in US treasuries and you're happy to sit in cash, good for you. You're getting paid to sit in cash. But then at some point when the NASDAQ starts to have like double digit sort of returns and you have zero allocation or very underweight, you're going to be forced into that, right? And so I think that you're getting a lot of that career risk management chasing happening as well that feeds upon itself. I think currently a lot of that's happening like in the last 2 weeks or so.
Yeah, almost I'd argue not somewhat of a blow off type of dynamic. But before we get into Michael Kramer, everybody please make sure you follow Weston Nakamura here on Twitter. He's actually staying up quite late or early. I'd give that 1:30 a.m. in his time zone. So he's kind of have to spend time, even though he should be sleeping. And if anybody want to come up and ask questions, click that bottom left mic request button. And as always, this will be an edited podcast under Lead Lag Live.
Yeah, sure. That's a great question. Just to start, the kind of almost parabolic, 30 something year highs that the Nikkei index started to break out to. Again, that was purely foreign. Domestic investors had been actually selling into that. Like GPIF, the government pension fund, the largest government pension fund in the world, and government pension fund. They just kind of put out their fiscal year 22 end. So which ended in March of this year. It showed that they actually, cut their domestic equity allocation. So Japan has not been participating in this upside, mostly been foreign. And with regards to the carry trade, how those mechanics work. So there's the concept of Mrs. Watanabe, which, both Michaels, I'm sure Michael Kramer as well, I'm sure that you're familiar with, but Mrs. Watanabe being this kind of, it's not really not a stereotype. It's a real thing, like a housewife at home who is just basically levered FX day trading. That is occurring. There's still a ton of FX, aggressive 25x levered trading happening in Japan, but it's now at this point, it's Mrs. Watanabe's kids as well as Mrs. Watanabe as well. But what you do is if you have a carry trade on, you're trading like swaps and you just basically get credited points. And as long as you basically have this positive carry like a daily basis, you get credited in an account like on a nightly basis, right? And a lot of times, like it's almost systematic where you can set it up where you have like a AUD JPY or an MXN JPY or whatever carry trade on. As long as you have a positive income at the end of the day, then you can just allocate that directly into like a SPX or a QQQ ETF overseas. And so that's mechanically how what happens on the Japan side. From the foreign side, on the institutional side, I'm sure there's just a lot of different complex ways in which that they would do that. I mean, take Warren Buffett, for example. Okay. So Warren Buffett is long these like 5 Japan trading houses, and he just disclosed, earlier in May of this year that he upped his stake in it, but he was already long his companies in, August of 2020, I believe, right? But what Warren Buffett did was also kind of like a yen carry trade, in which what he did and what he's currently still doing is he borrowed funds. Berkshire Hathaway issued bonds, yen denominated bonds at rates at zero. So he basically issued, bonds for free in JPY. And then he took those proceeds and then he bought equity stakes in these 5 Japan trading houses. And those trading houses, by the way, what they are, they're massive conglomerates. They hold each of them have like 1,000 subsidiaries ranging from convenience stores to whatever it is. But by and large, they're commodities plays. They move up and down with the price of commodities. So what Buffett did in late 2020 was he did a brilliant macro trade. He went short bonds and long commodities before interest rates and commodities skyrocketed. But that, in a way, that is another form of a yen carry trade. And so there's anywhere from like the Buffetts to the short-term, highly levered, risk-taking, Japan retail investors. There's so many ways to do it and everything in between. But that's the general concept, is that Japan has free money, essentially, relatively speaking. And so you borrow yen and you fund whatever it is that you need to fund. And they typically are risk assets. That's something I'd like to ask both the government of Japan, the Bank of Japan. You're absolutely right. Okay, so what Bank of Japan just did, they lifted yield curve control, upper band caps on 10-year JGB yields, essentially to allow them to trade as high as 1% from previous 50 basis points, from previous 25 basis points in December. So if you think about it, and I just talked about this in my last episode of my podcast, in which I go over in detail what just happened with Bank of Japan and all the implications, right? But so yield curve control, what they're doing is really has nothing to do with inflation. The tweaks and whatever it is has nothing to do with Japan inflation, because current inflation in Japan was not generated by Japan monetary policy or yield curve control. And this is very evident because they've been at this. They've been at radical experimental monetary policy. Yield curve control has been around since September of 2016. During that whole time, Japan did not experience the inflation that they were trying to target. And that was the whole purpose of this. Japan inflation is currently happening because there's global inflation happening. And so when people are talking about, people need to, the Bank of Japan needs to unwind yield curve control because inflation is now appearing in Japan. Yield curve control didn't cause the inflation in Japan. So why would the removal of that fix the inflation in Japan? They're just not connected. What is connected, however, to yield curve control directly and very apparently and obvious is Japan's budget, Japan's borrowing costs, the way that the Japanese government could fund itself. As you said correctly, it's astronomical. It's one quarter of Japan's budget goes to servicing interest on its debt. Interest that has been on the floor, mind you. Okay. And so it is just increasing. The debt burden is increasing. You have an aging population that is not contributing to the tax base, and you have, a much smaller tax base contributing. And so obviously what you need is the printing press in order to both fund the government's expenditures, basic operating expenditures, as well as to keep interest rates, those funding rates low as possible. Yeah, there's going to be the reason that, you're not going to get into this quote unquote cycle, in my view, of the Bank of Japan to start lifting the 10-year yield cap again and again and again consecutively from here. Like, this is not the start of anything, because if they do that, that's what, in like 3-4 times, you're going to have like 100% of the budget go to just servicing interest on existing debt for Japan. And so that's just basically my view of that. But I think that you're totally right to think about it in that sense. Like, just get about the whole, is inflation happening in Japan or whatever it is, and look at it from strictly what is Japan's fiscal situation look like? It looks horrendous. So yield curve control in some form is here to stay. Easy monetary policy is here to stay in some form. They'll try to make little adjustments here and there just so that they can have a little bit more breathing room, so that they don't have the yen get crushed every time you have yields globally surging when you have 10-year US Treasury yields or whatever they are surging, and then the Bank of Japan has to just cap yields at some arbitrary level and see nominal yields spreads blow out, and therefore USD JPY blow out. As to your question of what's up with like the yen reaction of getting weaker as opposed to stronger, this was a huge kind of confusion to me at first, because I actually, going into this, I had a short EUR JPY bet for, basically ECB to BOJ policy convergence, right? Because those were the two most diverged, right? They both started as major central banks that had hugely bloated balance sheets and rates, their policy rates in negative territory. And then the ECB went out of negative territory and ripped rates higher and, are no longer buying, sovereign debt. Whereas Japan still has a negative policy rate and is indeed still buying sovereign debt. And so that is policy divergence. And that's why you see the euro just massively stronger against the yen as opposed to USD JPY. And so that was my short bet. And so on Japan Policy Day, first of all, you have a leak, quote unquote, leak out of the Nikkei, which is basically now at this point just like a state media. This is the second time in the last 3 meetings that this has been done under this new governor, where they would leak, they would reveal what the policy is ahead of time, hours ahead of time. And then you get the market reaction. And then you have to get the actual policy to come out. And then you get the further market reaction. And yeah, that's a horrendous sort of mechanism. But what that does do, and I talk about this in my last episode of market depth, but the kind of one good thing, I suppose, is that what that does is it allows for a lot of this pent up speculative positioning or overcrowded positioning to just get the pressure out of it, so that it doesn't happen, all that reaction and unwinding doesn't happen all at once, triggering margin calls, triggering stop losses and all that. And then, they're potentially mitigating far more, global cross-asset, like unwinded volatility in other markets as well. And so just to mitigate that. But when you reset the entire, positioning complex going into a catalyst, and that catalyst suddenly just happens randomly earlier, I mean, you have options expiries, all these things that just kind of get messed up. And so I think right now what you're seeing is a combination of positions that got cleared out earlier than they expected because goalposts have been moved. You have, and so therefore you have that unwind plus new positions coming in and that. And then you also have just a pure disagreement amongst market participants as to what this means, because what the Bank of Japan did was not its usual kind of lifting of the yield curve control cap. They made it very vague on purpose. And so people don't know what to make of this. So you're seeing confusion within as reflected in markets currently with what the BOJ did and relative to the other major central banks who are currently on this precipice of turning from raising rates to pausing to, ending and all that. And so I think all of that's playing out right now. I don't necessarily see the yen weakness necessarily as in the immediate term to the last per se for the shorter term, but I really don't know. I kind of threw the towel on to try to understand this. I don't understand the price action right now, other than, I looked at yield spread differentials. I looked at positioning. I looked at, yen futures, yen options positioning. I looked at other currencies positioning. I looked at, correlations with like Michael was saying with crude oil. A lot of times, the dollar yen does move with energy imports and all that. And yeah, it's just very difficult for me to understand. So I don't really have, an answer other than what I just laid out.
Yeah. And actually, that was a direction I wanted to go as far as just, the idea of global central bank coordination. It's not clear to me that there's as much coordination as we've seen before because, everyone complains about the Fed being late to the game. It turns out maybe Japan is the one that's the most late.
Yeah. Well, what do you mean by coordination? Like that they are doing this?
That they're all talking, that they also, are aware of sort of their next move. If the Bank of Japan is purposely developing policy, which is a bit ambiguous because they themselves are unsure. I don't even know how you could possibly communicate that to other central banks properly. Yeah, to your point.
Yeah. So this is, I had an episode about this market depth recently so in Sintra, Portugal, recently, you had the ECB event in which the final panel was Christine Lagarde, Jerome Powell, Andrew Bailey from the Bank of England, Governor Ueda's first from Bank of Japan. It was his first international English speaking experience, kind of debut. And like Sarah Eisen from CNBC was the moderator. I really do have to give it up to her. She did a fantastic job of moderating. And she asked them twice because once she was kind of interrupted and brushed off, but she came back to it. But she asked all four of them sitting on stage, literally, she's like, do you guys talk amongst each other, like before policy meetings? And then Christine Lagarde, the first time she asked, Christine Lagarde kind of brushes off. She says yes, but then she says, but can I go back to what Jay said? And then later she comes back to it and she said, so I asked before, but do you guys talk? And then there's like a very long, awkward pause where all of them are just looking around at one another, and she just keeps firing away at the questions. And then finally, Andrew Bailey says like, oh yes, of course we talk. We talk frequently, of course. But what we don't do is we don't say like, what should you do and what should we do? But we talk about, because we have similar issues to different degrees, but we just try to figure out what's going on in the world. Okay, that's a nice answer of what you don't do. What you are doing, however, the only reason for people at your level, at the highest levels to talk, is because you actually are giving kind of a heads up as to what it is that your respective central banks' upcoming policies, meetings and are going to likely result in. And you're doing so because then this is where, like, I guess the coordination part comes in. Central bank coordination is not necessarily like we're all directionally easing or directionally, tighten policy. It's more so just giving a heads up, like, about this is what we're going to do, this is what we're going to do. Just letting you know. I don't care what that means for you or whatever it is, but I'm just letting you know, just a heads up, right? And of course they do that because what else would they be each discussing amongst each other? Macro data point, like they have staffs, thousands and all that. The only reason for them to talk is to do that. And so I think, and again, this is part of why I threw this episode, but what I said was watch Christine Lagarde going into last week of the three central banks before they had their policy meetings. You had Fed on Wednesday, the ECB on Thursday, you had Bank of Japan on Friday. Before that, what I said was watch Christine Lagarde. She's like the most kind of important one. And watch to see if there's any sort of difference in her sort of kind of behavior during her press conference, right? And if she went from the last ECB meeting in which she was very, very hawkish, pounding the table, saying, we are not done yet. I'll tell you right now, we're also going to hike in July. She said that also in May. And then suddenly she just went to, literally her quote was, it's currently a decisive maybe if we're going to hike or not. There's a clear shift in tone. Jay Powell, 24 hours before that, the most useless press conference I've ever seen him give. He said absolutely nothing in terms of guidance. Why? It could be a ton of reasons why, but something that did happen was that BOJ's Governor Ueda, definitely gave them a phone call, a heads up ahead of time, saying, hey, BOJ, I'd like to move this week. And so the reason that they can't necessarily project anything or say anything is because nobody knows what that going to, what the market implications or what anything like that's going to do. When the last bastion of QE removes or, lifts some of that anchor up, who knows what can happen? And so that's why, in my view, that's what explains their kind of sudden shyness. But yeah, I think that in terms of like global central bank coordination, I think that's definitely happening. And there was definitely like a heads up given, as they had all admitted to in Sidra, from Governor Ueda to the others. And I think that you saw that was very apparent on their respective press conferences. And it goes to the again, the uncertainty. Even they didn't know what the policy was, or if they knew what the market reaction would be, or something like that, right? You could very well have the risk of Japan lifting 10-year yield caps and things like that is not necessarily the kind of this narrative of repatriation of all of these trillions that Japan has invested brought back home because there's a few basis points more yield. Of course, that is indeed something that has happened, but that happened in 2022. By and large, Japan were massive sellers on record of things like U.S. Treasuries. That's why you get one of the worst total return bond performances in 2022, because the large foreign creditor or large foreign U.S. Treasury holder was dumping a record amount of treasuries. but there is some element of that, but what's the risk more so is more of like a market mechanical technical thing, where in which if you have sovereign government bond markets that are supposed to be the largest and most liquid and relied upon to be very large and liquid, but they're actually not as kind of liquid as perceived to be due to things like QE and huge sovereign or huge central banks having a massive presence within these markets and then kind of removing their giant footprint and leaving pockets of illiquidity and market dysfunction in sovereign bond markets. It structurally changes the way that like things like trading liquidity, operates. And so when you get a huge move like in March of this year, where you have like the, Silicon Valley Bank or whatever, and you saw moves that were like 2-year treasuries moving 100 basis points, like 1 full percentage point in the matter of days. The 2-year German Bund is doing the same thing, record swings, biggest since Black Monday 1989. But if you look at like the JGB markets, JGB 10-year yields went from above 50 basis points and got spliced in half within a day and a half, right? All of those things are basically a reflection of, and then you have hedge funds blowing up, macro hedge funds that have weathered through the Asian financial crisis in the 90s, through 2000, through 9/11, to 2008, through the European debt crisis, through the US debt ceiling, all of that stuff, obviously COVID. But then March 2023, they blow up. Like, it's because you're seeing insane rate volatility occur, take place and occur. And that's occurring because of, because of illiquid sovereign bond markets, including that of U.S. Treasuries. And the risk is that if Japan makes a sudden move in its JGB cap, then it can trigger like a moment or flash moment of illiquidity and a huge price move in any of these sovereign markets, including the U.S. Treasury market. And then that would start to feed upon itself. Leverage positions get unwound, force unwound, or this or that. And basically what you saw in like October of 2022 in the UK gilt market, in which the Bank of England had to step in and start bidding for unlimited for the long end of the gilt curve. You can see that happening in the US Treasury market or whatever it is. And so that is really the risk that I think that central bankers are really more so afraid of, rather than the longer term outflow from Japan asset managers and pension funds and insurance companies out of fixed income for back in Japan trading.
Right. Which again goes back to why I'm framing it very purposely, not because I'm trying to scare people, but when I say global margin call, I'm being actually very literal when I say that. But I want to be respectful of your time, Weston. Everybody, please make sure you follow Weston here. I got 3 other people that want to ask questions, being mindful of time, just given that it's pushing 2 a.m. for Weston, and everybody has to give him incredible props for staying up and doing the space.
So I think that at any point, and this is evident in March of 2022 or 2023 of this year, when you saw like these insane moves happening in the front end of U.S. and German and Japanese, government bond markets make these crazy moves. I mean, what if that were just fine? That was like yield collapsing. In other words, bond price up. What if that went the other way around? And you saw 100 basis point move upwards in 10-year treasuries or something like that, right? So those things, they can happen at any moment for any reason. It doesn't have to necessarily be some sort of fundamental catalyst. It could just happen because literally like some other market move that triggers something else, and so on and so forth. So do I see that happening? I see that we are sitting on a dynamite keg and kind of flicking matches at it, but that can go on forever and that can blow up at any time. But as far as the lower paper cuts thing, so from what I'm seeing and hearing here, and don't put too much waiting on this book because it could always change, but the long only like Japanese institutional money that has a lot of foreign bond exposure, even if JGBs were yielding a whole percent at 10, right? That's not very enticing. And yes, hedging costs are extremely high to hedge, to FX hedge to buy like US Treasuries, such that it wipes out the entire nominal yield spread and all that. But there's a lot of, like major insurance companies that have been taking unhedged exposure and all that. So I think that this notion of a huge repatriation back to Japan might be overblown. Japan is not necessarily that attractive at 1%. Even if it were that, it's not that at all. It's that's 60 basis points currently on 10-year. But another thing too, is that if the Bank of Japan is perceived to be on a so-called rate hiking cycle, why would you rush in now, right? You're going to wait until they're done crushing the JGB market, whatever, and then that's when you're going to flow in. So just because Japan suddenly has overnight 10 basis points more yield, that's not when they would necessarily start buying. Now, I did say earlier that it's more mechanical, and so they might start doing that. But overall, if that's the case, they're going to wait to see the Bank of Japan is truly on some sort of cycle or not. And and only time will tell if they are or not. And once that time passes, then they might start to make serious market impacting reallocation decisions. But an overnight thing, I don't see. But an overnight blow up from a volatility event, that could happen as soon as this call ends. Or not at all.
Let's hope not.
Any time that I guess anybody, but maybe me specifically, because I have a very strange I'm a very strange character, but it sounds very conspiracy theory-ish, right? So that said, I've thought about this endgame thing for a very long time. One of the scenarios is, what you're saying, basically deflate the debt away. What I think is that when Abenomics first started out, it was like an earnest attempt to generate inflation and all that by buying up massive amounts of JGBs and all that. But then when that didn't really pan out, and these radical experiments of just QE on steroids, it's happening. And now it's happening because they're trying to, defend yield pegs and all that. And it's not necessarily to generate inflation. It's to kind of battle JGB short sellers or whatever it is. And then they're accumulating more and more of the, 53% of sovereign debt outstanding. I mean, when you own 53% of the JGB market outstanding, of the issuance outstanding, you're not going to you're going to sell that into a market that you've destroyed. You're going to blow up yields on yourself, right? There isn't a quote unquote tapering or a balance sheet unwind happening in Japan ever, I don't think. And so I think that it either results in basically the deflating debt away, or, and this is my kind of, I guess, controversial sort of thing, is the quote unquote canceling of the debt, right? In which the Bank of Japan owns enough of the float of Japanese government debt, in which that the remaining holders, which are mostly domestic Japanese anyway, can get paid back 100 cents on the dollar, maybe 101 cents on the dollar in full, on time and all that. But the rest of it, the Ministry of Finance owes that principal to the Bank of Japan. They default on themselves. And that it'll package it into maybe a perpetual, whatever it is, 0% perpetual or bond that they've created that sits on the Bank of Japan balance sheet. But I think that might be what is kind of not necessarily a goal, but the pull the emergency cord, sort of end game scenario. And if that happens, it might not be doom and gloom. And by the way, so what might trigger that is you have to have something serious to trigger that. And so what I think that would be the next major earthquake. And by the way, earthquakes are kind of like mini earthquakes, and larger ones are starting to happen again in Tokyo. And it's right around that time where after that first one, 2011, there's supposed to be another one to release the pressure from that first one. That's supposed to happen in 10, 15 years. So we're right around those levels. So something like that would give them an excuse to do something very, very radical. It can't just be drip, drip, drip price levels. And therefore suddenly you wake up one day and Japan has decided to excuse itself of its debt. So that could be a catalyst. But What I think that the outcome, a positive outcome, and this is just like in the kind of greatest of all scenarios, which is like unlikely to happen, but it might be that if Japan is able to just kind of do some accounting trick in which it goes from being the most indebted country in the world to suddenly not, suddenly having what, like 40% of the GDP or something like that, then it's now from like a credit profile that it's like the worst, best OECD credit profile in the world. Is everybody else who were JGB bondholders, they'll look around and they say like, all right, did Japan screw me over? And if the answer is no, did I get 100 cents on the dollar? Yeah. Okay, I guess there's no problem with that. And then if you think about the Japan public and the population, for which over half of Japan's household assets are in cash, and the reason it's in cash is because of this massive government debt that's overhanging, and this narrative that you hear everywhere saying like the government's not going to be there for you. You need to save $200,000 by the time you retire because the government is just not like, you're not going to get Social Security or pension. Like that's all going to, it's all a fantasy. And so all of that cash hoarding and the deflationary sort of mindset because of this debt overhang, if that suddenly disappears, then T plus zero, those savings, those emergency savings now turn into disposable income. And that might then turn into spending and, consuming of goods and services and a vibrant and healthy 2% virtuous cycle that they had been kind of aiming for all along with relatively, attractive debt dynamics relative to those other, G20 around the world. And so that might be like the kind of happiest scenario. Unlikely again, but it's not all doom and gloom. It might be that. But again, it would take to do that, it would be such an extreme measure. It would take like an earthquake sort of thing to happen, which is a very big possibility. Regarding their ETF holdings, and I don't have the latest figures in front of me, but there's sometimes like every now and then, I guess recently we did have it pop up again, but there used to be a lot of like media articles that would come out every now and then that say like BOJ owns like 80% of the equity market and so on and so forth. The Bank of Japan, just to be clear, it does own like something like 70 or 80% of the ETF market. But ETFs are a very, relatively speaking to like especially the US, not a large part of the overall equity market capitalization of the Japan stock market. So what it ends up being is something along the lines of 7% of the total Japan market cap, equity market, is owned by Bank of Japan. Now, 7% or one share is too much, in my opinion, for a central bank to own equity and common stock and anything. But it isn't necessarily like the Bank of Japan is the equity market. The Bank of Japan is, or was, I guess, the ETF market, like literally like Nomura, stuff like that. They started to roll out, index ETF products because a gigantic new customer came in and literally created the ETF industry in Japan. But if how they unwind that, it's unclear. Recently, and I went over this in my podcast recently as well, you had a sell-off, a pretty sharp sell-off one day, midday, and during the cash equity trading session, because in the parliament, there was discussion happening between an opposition candidate grilling both the finance minister Suzuki and Bank of Japan Governor Ueda. And they started to get into a discussion about the framing of the discussion was about wealth inequality, generational wealth inequality, how young people have no assets and how the older people like 60 and over own something like 90% of financial assets and all that. And so what they were saying was, why doesn't the Bank of Japan, with its like 36 trillion or whatever of ETF holdings, why don't they transfer that or give that to the youth in Japan? And that way they actually have equity investments and stuff like that. And then the topic of, I don't know, from what God knows what reason, but they started talking about at what price. And they said basically at book value or below book value. And when at that point, Topics Index was trading at like 1.6 book value. The Nikkei Index was like 2 times book. So you're basically saying, okay, the BOJ is going to unload to the government at current half price. And then so that took a massive spike down on the index off of that. But to answer the question, I really don't know. It does bring up governance questions and all that. And I think that that the equity holding part of it, even if it is small, and even if it's done passively via ETFs and all that, if the Bank of Japan is on like the list of holders, if you look at it on Bloomberg, that's going to be a hindrance or sort of a wall to the foreign inflows going into Japan at some point. I would think like the fact that you have the central bank that is a fellow shareholder and that can unwind the position. And if something happens in a quote, unrelated matter in like be it currency or be it like the JGB market, if they need to therefore start moving that, equity holding, what does it mean for my equity portfolio, my, Japan or international equity portfolio and all that? I think that that's going to be a cloud over, or at least a sort of soft stop from like the otherwise kind of rapid flows into these. So a representative X, but I don't get into discussions about that kind of stuff right in the first place. Like he's like taking the bait. By the way, Bank of Japan Ueda during that conversation said, this is not opposite. We're not good. This is like a moot point of discussion. We should not be even having this. But it theoretically, if we were to unwind the equity position, we would do it at market value and not book value. So just so like he did say that. Also, I don't know if it has anything to do with anything, but when they were trying to look for Kuroda's successor, the Bank of Japan governor's successor, Akio Toyoda, who stepped down recently from being the CEO of Toyota, was speculated to be the BOJ governor, tapped, which he did not get. I don't know if that has anything to do with anything either, but yeah, it'll be interesting to see. But yeah, Japan is large. Toyota is the largest market cap stock, and so that's going to be. I think you're right to focus on that and to look at that as precedence for if they were to unwind their position on that. That's probably going to be how they do it for the others as well, and they're probably going to start with Toyota.
Weston, for those who want to track more of your work, it was mentioned a little bit earlier, but where do people turn to?
Sure. So you can follow me on Twitter at Across the Spread, which is kind of make market commentary. I make kind of stupid macro memes here and there because I am a clown after all at the end of the day. And please follow my podcast, subscribe my podcast. It's on Blockworks Macro. It is on YouTube at Blockworks Macro, and then also on Spotify and Apple. And so if you subscribe, if you like it and all that, I greatly, greatly appreciate it. Ton of effort goes into it, and never, ever, ever, like I can say this like with a straight face, I would never, ever put out anything unless it was something of value. You're not going to this is not news regurgitation or anything like that. This is differentiated kind of angles of how to look at things. And I wouldn't also bring anything up unless it had impact on your equity portfolio or your, investment portfolio outside of Japan. This is not for Asia investors or investment into Asia. This is for outside of Asia and something that can impact your portfolio outside of Asia that stems from this third of the world. So it's called Market Depth, Blockworks Macro. That's where you can find my work. And Michael, thank you so much for this, and thank you for your great work as well.
Thank you for joining. Hopefully I'll see you all in a bit when I do another space, talk about Bitcoin and how all this plays into potentially a divergence relative to the NASDAQ. So thank you, Weston. Thank you, everybody. I'll see you all later. Cheers.